Hello, this is Andrew Westhof, owner and senior loan officer of Homes Mortgage Lending, and I want to talk to you today about why property taxes increase in Michigan and on pretty much any home that you purchase, and oftentimes substantially. So I want to show you how that works, the reasons behind it, and I'm going to give an in-depth example as well towards the end of the video. So if you want to get the gist of how this works and why it happens, the first half of the video will cover that, and then the second half of the video will give you the in details if you want to see the math behind it as well. So I'm licensed anywhere in the state of Michigan. If you are looking to purchase a home, all my contact information is in the video notes. Feel free to contact me, or if you just have any questions on how this works, feel free to reach out, or feel free to leave comments in the video comments also. And if this is helpful, please like it. I do many similar videos on mortgage information as well as interest rate updates, so please subscribe to my channel if you'd like to see that stuff. I'd really appreciate it. Thank you. So without further ado, let's get into it. So how property taxes adjust in Michigan. So first, why do property taxes increase after you buy a home in Michigan? So the reason is that the taxes are artificially lower for pretty much anyone you're buying the home from. There's caps on how much property taxes can increase when you own a home in Michigan. The caps are 5% or the rate of inflation, whichever is lower. So in most cases, until recently, inflation's always been lower. So property taxes have increased very minimally for the homeowner, which is great when you're the homeowner. But when the home sells, those caps are lifted and the home is almost always reassessed pretty quickly, so that whatever municipality you're buying the home in can get the max taxable tax revenue from you. And then those caps are put into place for you, and you keep those caps and have minimal increases after that first year. So usually you see the big jump the first year, and then after that, very minimal jumps each year moving forward. So how it works is the home is sold, the value is reassessed by the municipality. So I'm going to show you in the example, but when you look at a property in Michigan, you're going to see an assessed value and a taxable value, and they're going to be different. So the taxable value is the amount that is actually being taxed on based on the millage rate, and then the assessed value is what it should be being taxed on. But if you look this up, and I'll show you where you can look it up in the example as well, the assessed value is often artificially lower as well. Not really on purpose, but because in order for the home to be reassessed, the municipality that you're buying the home in has to send an assessor out, and they don't really want to spend the money to send an assessor out when they have caps on the taxes anyway. So they're not making any more tax revenue if they assess your home higher, and they know they're going to reassess it once the home's, if you sell the home. So they don't do it on a regular basis. Sometimes they don't do it until the home sells, depending on the municipality. The taxes are going to be updated based on the new assessed value, based on the current millage rate. So they're going to reassess the home, and because those caps are lifted after they do that assessment, the taxable value and the assessed value are going to be equal. And then from there, in years moving forward, is where the taxes will be capped on how much they can increase. That taxable value will be capped. And then mortgage companies may take some time to reflect on the tax bill, the new payment with the new taxes. So mortgage companies do what's called an escrow analysis, and many of them, probably most of them, do it on a yearly basis. So when the actual taxes increase and when they do that, escrow analysis could differ. So even though your taxes have already increased, you may not even see that reflected on your mortgage payment for a while, which is kind of a bad thing, because if they don't do that escrow analysis and increase the payment based on the new tax amount, you're kind of falling further and further in the hole. Your escrow account will go negative, and then it'll get a little bit of a bigger hit on the increase. So I'll explain how that works here at the end too. If you're not planning on watching the nitty-gritty on the math, I'll give you one piece of advice right now, is that when you're buying the home, you'll want to get an estimate from your loan officer on what the taxes are going to increase to. I do that automatically, so that my clients don't have a big surprise when the taxes increase. And then my suggestion is to, from day one, when the payment is artificially lower because the taxes haven't increased yet, whatever the amount that we're expecting it to increase, whatever the estimate is on that monthly amount, put that additional amount in your savings account each month, so you're accounting for it. So when the taxes go up, yeah, your payment will go up based on the taxes, but when your escrow is short because your taxes were higher than what we expected to have to pay, you can just pay off that shortage and not have it increase further, if that makes sense. There is a summer and winter tax bill that can complicate things a little bit further, because the summer tax bill might go up and then the mortgage company adjusts the payment. Then the winter tax bill goes up and they don't adjust the payment again for another year. So it just kind of makes it a little bit convoluted based on the timing of when you bought the home and when the tax bills come out and what the mortgage company does to the escrow. So the biggest takeaway here before I go into the example is you got to plan for the increase and know when you're out shopping for a home that the taxes are going to be very similar from area to area. If you're looking at homes in the same neighborhood, if two homes are the exact same and are valued the exact same, it doesn't matter which one you buy, the taxes are going to go to the same amount once the taxes are reassessed. So if one has quite a bit lower current taxes, it's not like that specific plot of land is just the lucky plot of land and those taxes are lower. They just have the current owners have probably purchased the home a lot longer ago. They've owned the home longer, so they've had that artificially lower tax increases longer, so the taxes aren't reflected. So it's just really important to be working with a reputable lender and loan officer who's running estimates of what the taxes will increase to, as well as giving you detailed quotes on the actual home, because otherwise you can certainly be in the dark. I have heard horror stories of clients who have bought in a home because every home we looked at in this area wasn't affordable because the taxes were too high. But then we found this one and the taxes were much lower. They didn't know the taxes were going to increase, and then they increased substantially, and the home is not really in their budget at that point. So make sure that you are getting quotes on the increases. And taxes are expensive, especially in Michigan and in Southeast Michigan, especially where I do most of my business. So you may look at the current taxes and go, well, they can't go up much from there. You might be surprised. So don't just go, oh, I know they're going to go up, so I'll plan on $50 more a month or something like that. It could be a lot more than that. In most cases, it is. So let's take a look at an example. I live in Chelsea, Michigan. This is a home that happens to be for sale in my neighborhood for $475,000. So let me pull this up. I'm going to show you first the website where I pulled this from, but I'm just not showing it on the actual website because I could. It's public information, but it's a home in my neighborhood. So just to not show the seller's name and their address and stuff like that. So this website is called BSNA Online, bsaonline.com. I'll put that website in the video description so you can check it out if you'd like to. But all I do is anywhere in Michigan we can scroll through, find the county and the specific municipality in the county. So we're looking at Chelsea, and it's going to let me type in the address and pull up their taxable information as well as some other public information about the property. So this is the screenshots that I took from that. Now notice on this BSNA Online, some municipalities don't have the taxable information. Some of them do, but they might charge you. It's typically $3 to pull it up. I do this for my clients at no cost because I'm very used to doing it every single day, and you don't really need to, but if you wanted to kind of play around on it, you can. You also can get information on who owns the home if you're curious about homes in your neighborhood that recently sold and you want to snoop. So the top part is this snippet that shows the assessed value and taxable value. So you can see here that they have different amounts there. Again, this home is for sale for $475,000. So typically you can estimate the assessed value is going to be about 48% of the appraised value. We don't have the appraisal yet, so I would just go off of the list price or what you get the home under contract for is the best we can do at this point to assume that's going to be about the value. So if this home is valued at $475,000 by the assessor, they're going to use about 48% of that for their assessed value. So $228,000. So the current assessed value is $147,000, so already significantly lower than what it shows on public records because it hasn't been reassessed and probably shortly after it was built. This is a newer home. So then this is going to show the taxes summer and winter for the last 4 or 5 years. So what the mortgage company does when they're qualifying you is they just take the summer taxes from last year, from the most recent summer taxes, so summer taxes for 2022, winter taxes from 2021, they're going to add those together and divide by 12, and that's what they're going to use to set up your escrow account, assuming you're escrowing your taxes. A lot of loan programs, you don't have to do escrow them, you can pay them out of pocket, but this is the math they'll also do to qualify you, to see if you qualify for the home. So here's what this would look like after pulling these taxes for this property. So we know the summer and winter tax bills, $3,417.30 for the summer, plus $2,878.04 for the winter. Those added together, $6,295.34. Initially, we're going to set up the escrow to include $524.62 per month, which is 1/12 of that total 6,295.34. We just divided it by 12 to get the 524.62. So we know the current taxable value is $130,827. That's what that $6,295.34 per year is coming from. So we can do the backwards math on it and just divide out $6,295.34 divided by $130,827. That gets us 0.04812 rounded. So what that means is the current tax rate is 4.812% of the taxable value, or they should be the assessed value before the caps are in place. So like we mentioned, assessed value tends to be about 48% of the appraised value. So at the current assessed value, $147,400, if those caps weren't on there, the taxes would go to $7,092.89. So if the city doesn't reassess the home, or the municipality doesn't reassess the home, no matter what, when that cap's lifted, the taxes are going to go up to $7,092.89, which is $591.08 a month, or about $66 more per month, $66.50 more a month than what the current taxes are. They are going to reassess it. They always reassess it, but without doing anything else, if the current assessment was accurate, that's what the taxes would go to. Now, as we mentioned, we think the assessed value is going to be around $228,000, so 48% of the $475,000. So if we multiply that $228,000 out by that 0.04812, we get $10,971.36. That's going to be what my estimate would be on what the property taxes are going to go to at the current millage rate. So that's $914.28 a month, which is $389.66 more per month than what the current property taxes are. So if you're not planning on this, if you're not budgeting for it, that's a pretty big hit on the increase on the monthly payment. So that's why it's really important to get a property tax estimate from your lender so you know what they're going to go to. So I want to talk to you a little bit about the impact on your escrow account. So what will often happen is the taxes will go up. The mortgage company will pay your property taxes even if there's not enough money in your escrow account. So if they planned on the property taxes being, in this scenario, basically $6,300, and they actually end up being almost $11,000, there's going to be a shortage in your escrow account when they make that increased payment for those higher property taxes. So they'll let your account go negative, and oftentimes they'll let it stay negative for a while and not change your payment until they do the escrow analysis, which might be about a year after you purchase the home. So if that happens, you're kind of getting further and further behind the eight ball. That's going further and further, not negative because you're paying escrow each month, but you're not paying enough to account for the next tax bill. So when they finally do the escrow analysis, whatever the negative amount in the escrow account is, well, now they want to get paid back. So they're not going to ask for it all at once, but they're going to just divide that negative amount by 12 and add that to your monthly payment for the next year. So you're going to pay it off in 12 payments at basically an interest-free loan from your mortgage company because the escrow account was short what they needed. And then they're going to take the actual amount that the tax is increased, which in this case is $389.66, and add that as well, so that they're collecting enough to pay the property taxes when they're due the following year. So you kind of get double hit. The way the math works is it's kind of, in this case, if it was $389.66, it'd kind of be double that. So that's going to be, almost $760 additional. So sorry, almost $780 additional. So you're already even if you're planning for the 389.66 increase, you're probably not planning for a $780 increase. So what I always recommend for my clients, what I mentioned before, is we'll do the estimate on what we think the property taxes are going to increase to. We know the escrow account is most likely going to go negative. It's just a funky thing that happens with mortgage escrows, and it kind of is what it is. But if we plan for it, and from payment one you sock away the estimated difference, you can just contact the mortgage servicer once you get that increase in the mail or that email that says, hey, here's your new mortgage payment. It went up significantly. You can go, hey, I think my escrow account's negative. And they'll say, yep, it is. How much is it? And you can just pay it off right then if you'd like to, so that it only goes up by the amount it should for the new taxes because you've planned for it to increase. You don't have to do that. You can take the interest-free loan if you want, but make sure you're budgeting for it to about double what we anticipate the increase to be. So if the increase, we think it's going to be $200 a month, plan for $400 when that happens, and know you're going to have that higher payment for about a year. So I hope this makes sense and was helpful. Again, if you have any questions, feel free to leave them in the comments. I'm licensed anywhere in Michigan. I've got great rates. So if you want to talk with a knowledgeable loan officer for your home purchase, please reach out to me. I'd be very happy to help. And again, subscribe if you'd like to see similar content, and I'll see you on the next video. Thank you. Hello again. I forgot to put this in the video, so just adding this at the end here, a little bit of a bonus for watching the whole video. So the state of Michigan has a really cool tax estimator website, and I'll put the website in the video description. But it's where you can put in the information for different areas, and it'll tell you approximately what the yearly property taxes will go to. So it'll ask you the state equalized value. Again, we're going to estimate this. I use 48% of the purchase price since we don't have the appraisal yet. And then you just drop down the county, the city, village, or township, and the school district, and it's going to give you the homestead and non-homestead yearly tax estimates. So for the city of Chelsea, looks like the millage rate hasn't changed much because that's pretty spot on to what I had estimated those at, within $100. I think my estimate was $10,971, and this is $11,072, so within $100. But it is 2020 millage rates. This video is being recorded in 2022, so they're a little bit delayed on the millage rates, but it still give you a pretty good ballpark as you're looking at homes. So I hope this is helpful, and again, look forward to catching you on the next video. Thanks.